Silver looks calm right now. $80 to $92. Quiet chart. No headlines screaming. Nobody on financial Twitter is having a meltdown today. But here's what nobody is saying out loud. 4 days ago, on February 24th, 2026, the White House formally transmitted Kevin Warsh's nomination to succeed Jerome Powell as chair of the Federal Reserve. The media covered the headline. The analysts covered the short-term rate path. Everyone focused on the 31% single-day crash in silver that happened on January 30th when the nomination was first announced. Nobody, and I mean almost nobody in the silver community, has properly explained why the Warsh Doctrine, properly understood, is one of the most secretly bullish things that could have happened for physical silver over the next 12 to 24 months. The surface story says Warsh is bearish for silver, strong dollar, hawkish rates, sound money, silver gets crushed. That is the story the market priced in with a 31% single-day crash. The deeper story, the one that takes more than a headline to understand, says something completely different, and that deeper story is what this video is about. OG John AG here. This is financial warfare education, not hopium. That means we go through both sides. The bearish case is real. The 31% crash happened. We are going to explain exactly why it happened, but we are also going to show you what the Warsh Doctrine actually says, not what the algos heard in the first 30 minutes, and why the full picture points in a direction almost nobody is talking about. Let's break it down. Segment 1. What actually happened on January 30th, the 31% crash explained. Let's start with the event that silver investors are still processing. January 30th, 2026, 4 p.m. Eastern, Trump announces Kevin Warsh as his nominee to replace Jerome Powell as Fed chair. Powell's term expires May 15th, 2026. Warsh takes the helm in May. Within minutes of the announcement, silver crashed. Not fell, not pulled back, crashed. From over $115 per ounce, near its all-time high, to an intraday low of $80.55. A 30% to 31% single-session decline, the worst single day for silver since March 1980. Silver Thursday, the Hunt Brothers, the iShares. Silver Trust, SLV, saw volume so extreme it triggered multiple circuit breakers. Pan American Silver dropped 25% intraday. First Majestic Silver, Hecla Mining, all double-digit losses in hours. Gold fell too, down roughly 9% to 11% on the day, but silver's move was 3 times worse. Why? The market's immediate read on Warsh was simple and fast. Warsh is hawkish. Warsh wants a smaller Fed balance sheet. Warsh is committed to dollar strength. Hawkish Fed plus strong dollar equals lower gold and silver. The algos sold first and asked questions later. The dollar strengthened immediately. And when the dollar strengthens, commodities priced in dollars get an automatic headwind. Every commodity, silver included. That is the story the market priced in January 30th, and it is not wrong. That analysis is correct for the short term, which is exactly why the 31% crash happened. But here is what the algos cannot do. They cannot read a 15-year body of work from Kevin Warsh and understand what sound money actually means for the physical silver market over a 12 to 36-month horizon. That takes more than 30 minutes of processing. Segment 2. Who is Kevin Warsh and what is the Warsh Doctrine? Let me put Kevin Warsh on the table properly, because most coverage treats him as hawkish Fed guy and stops there. That is not sufficient. Kevin Warsh served as a Federal Reserve governor from 2006 to 2011. He was in the room during the 2008 financial crisis. He watched the Fed's balance sheet explode from under $1 trillion to $2.3 trillion through quantitative easing. He was one of the first insiders to publicly question whether that expansion was healthy or sustainable. Since leaving the Fed, Warsh has been one of the most consistent critics of what he calls monetary dominance, the idea that the Federal Reserve has become the primary driver of financial conditions, asset prices, and economic outcomes. His criticism is not that the Fed should crash the economy. His criticism is that when the Fed is the buyer of last resort for everything, markets lose their ability to price risk correctly. And when markets lose their ability to price risk, the distortions build up until they correct violently. His phrase for what he wants to restore is sound money, and his specific policy agenda, given what analysts are calling the Warsh Doctrine, has 3 main pillars. Pillar 1, cut short-term interest rates to approximately 3.0% through 2 25 basis point cuts in June and September 2026. This is the rate cut part. Markets expected this, priced in. Pillar 2, aggressively reduce the Fed's $6.8 trillion balance sheet, not by the passive runoff Powell was using, but by actively selling assets. Specifically, sell the $2 trillion portfolio of mortgage-backed securities. Return the Fed to a Treasury-only balance sheet. This is the QT, quantitative tightening, part. Markets partially priced this. It is why long-term yields went up even as short-term rates were expected to fall. Pillar 3, end the Fed put, Remove the implicit guarantee that the Federal Reserve will bail out markets whenever they fall far enough. Return price discovery to markets instead of having the Fed suppress volatility artificially. The combination of these three pillars is what analysts are calling QT4 cuts. Lower short rates, higher long rates, smaller Fed footprint, real price discovery. Now here's the question nobody is asking. What happens to silver when real price discovery returns to markets? Segment 3, the bearish case. Why Warsh looks bad for silver on the surface. Before we go further, the bearish case on Warsh for silver is real and must be taken seriously. Strong dollar. The dollar strengthened immediately on Warsh's nomination. A stronger dollar makes dollar-denominated commodities more expensive for foreign buyers. Less foreign demand for silver. Bearish. Higher long-term yields. The 10-year Treasury yield surged to 4.26% on January 30th. Higher yields mean higher opportunity cost for holding non-yielding assets like silver. Every dollar in silver is a dollar not earning 4.26%, risk-free. Bearish. Reduced inflation expectations. The main reason silver ran from $30 to $120 in the Powell era was inflation fear. If Warsh's sound money policy successfully reduces inflation expectations, and the market believes it will, the inflation hedge premium in silver partially disappears. Bearish. The Fed put removal. If the Fed is no longer going to bail out markets when they fall, risk assets sell off harder in downturns. Silver historically gets sold during risk-off events. Not as hard as stocks, but it gets sold. Bearish for volatility events. And the numbers confirm. Silver crashed 31% in one day on Warsh's nomination. That is not a small signal. The market spoke loudly. This is the legitimate bear case, and it deserves full respect. Now here is why the deeper story is different. Segment 4. The hidden bullish case. What sound money actually means. Let's talk about what sound money means in practice, because this is where the Warsh doctrine becomes secretly, quietly, powerfully bullish for physical silver, and almost nobody has connected these dots. What does sound money mean? It means the government acknowledges that it cannot keep printing its way out of problems forever. It means the Fed acknowledges that its balance sheet has been a distortion machine, not a stability machine. It means real price discovery, where the price of money and the price of assets reflects actual supply and demand, not Fed intervention. Now ask yourself, if real price discovery returns to financial markets, what does that mean for paper silver versus physical silver? For the last decade, the price of silver has been set primarily on Comex, the paper derivatives exchange, where right now there are approximately 20 paper claims for every 1 ounce of registered physical silver, where 31,128 contracts traded while the public screen was frozen in February, where margin hikes and halts and rule changes suppress the paper price independently of what physical buyers are willing to pay. Real price discovery does not support 20.1 paper to physical leverage. Real price discovery does not support a system where Shanghai pays $12 more than Comex for the same ounce. Real price discovery closes that gap, not by Shanghai coming down, by Comex coming up. Warsh's sound money doctrine applied to silver means the paper market eventually has to reflect the physical market. That is the opposite of what the paper market has been doing for 40 years. Here's the Warsh paradox that nobody is saying out loud. His doctrine calls for removing the Fed as the market's artificial price suppressor. For most assets, that means lower prices as the Fed put disappears. For silver, where the paper market has been artificially suppressing the physical price through leverage and halts and rule changes, removing artificial suppression means higher prices. Sound money is bearish for inflated paper assets. Silver is not an inflated paper asset. Silver is a suppressed physical asset. Segment 5, the 6.8 trillion balance sheet and what happens when it shrinks. Let me go deeper on the balance sheet story, because this is where it gets specific and where the hidden bullish case for silver becomes most concrete. The Fed currently holds $6.8 trillion assets, primarily U.S. Treasuries and mortgage-backed securities. Warsh wants to actively sell MBS, the $2 trillion portfolio, starting in mid-2026. What happens when the Fed sells $2 trillion in MBS? Mortgage rates go up. Home prices face pressure. Real estate investment trusts, REITs like AGNC and Anali, face a funding squeeze. The commercial real estate sector, already facing a maturity wall as low-rate debt from 2016 to 2021 comes due for refinancing, faces an existential stress. Companies that relied on cheap long-term capital to fund operations start defaulting. MUFG's head of U.S. macro strategy, George Goncalves, wrote directly, "The balance sheet reduction faces massive practical obstacles. Bank regulations require specific reserve levels that depend on the Fed holding securities. Changing that framework requires regulatory changes that take time. which means the Warsh Doctrine may intend aggressive balance sheet reduction, but the practical path is slower than the rhetoric. And during that transition period, while long yields are high, while real estate is stressed, while private credit faces its own bubble pressure, what does capital look for? Real assets, finite supply, no counterparty risk, historical monetary function. Silver fits all four criteria simultaneously, not because of inflation, because of capital preservation in a world where the Fed is admitting its $6.8 trillion balance sheet was a mistake that now needs to be unwound. Every $1 trillion the Fed unwinds is $1 trillion of implied admission that the paper system was extended beyond its natural limits. And every ounce of physical silver in a vault somewhere is an implicit bet that the paper system's limits matter. Segment 6. The Coin Shop Reality Check. Let me bring this down from the macro theory to the ground level. Because right now, while Kevin Warsh's Senate confirmation is pending and the financial media is debating basis points and balance sheets, what is actually happening at the physical level? Coin shops are reporting the same split reality we have been tracking for weeks. Front cases, American Silver Eagles, Mercury Dimes, pre-1964, 90% silver, flying out, priced and gone. Dealers cannot keep specific bullion categories in stock. Back rooms, sterling silverware, old jewelry, bulk junk silver, backing up, refiners delaying. Same as last week. Same as the week before. That split has not changed because of Kevin Warsh. That split has not changed because silver crashed 31% on January 30th. That split existed before the crash. It exists after the recovery to $92. Think about what that tells you. A 31% single-day crash, the worst since 1980, did not change the ground-level physical dynamic. The people buying Eagles at the front counter were not selling because the paper price crashed. They kept buying. The dealers couldn't keep Eagles in stock even during the crash. And what does that tell you about the Warsh Doctrine's impact on physical silver demand? The people accumulating physical silver are not accumulating it because of paper market price signals. They are accumulating it because they understand the structural story. 6 years of supply deficit, 86 million ounces of registered Comex inventory. Shanghai paying $12 premiums that survived a $6 paper slam. The Warsh Doctrine does not change that structural story. The Warsh Doctrine's sound money philosophy, if anything, validates why those people are accumulating physical instead of paper. Segment 7. The practical obstacles, why Warsh may not be able to do what he says. Let's be honest about the implementation risk, because the Warsh Doctrine as stated and the Warsh Fed as implemented may look very different. CNBC reported directly on this. Analysts at TS Lombard said the balance sheet reduction will not pose a material threat to asset prices. MUFG said they do not expect a Warsh-led Fed to quickly reduce the balance sheet because bank regulations require reserves and changing those regulations requires time and political will. The Senate confirmation process will be contentious. Democrats and some Republicans will challenge Warsh aggressively on his balance sheet plans and his views on the Fed's employment mandate. The confirmation itself is not guaranteed to be quick or smooth. Once confirmed, Warsh faces a FOMC that he does not control unilaterally. The Federal Open Market Committee has 12 voting members. Warsh is one vote. He can set the agenda and the tone, but he cannot simply override the committee. Previous Fed chairs who came in with aggressive agendas found that the institutional inertia of the FOMC moderated their policy positions significantly. And if Warsh moves too fast on balance sheet reduction, if long yields spike too high and the Treasury market starts to seize up, he faces what analysts call an embarrassing policy reversal. The same kind of pivot that happened in the UK in September 2022 when the Bank of England was forced to reverse its quantitative tightening in the middle of a gilt market crisis. The practical obstacles are real, which creates a scenario where Warsh talks sound money but implements it slowly. Cuts rates as planned in June and September, makes some progress on balance sheet reduction, but cannot move as fast as the rhetoric implies. In that scenario, you get lower short rates, bullish for silver, without the full deflationary pressure of aggressive balance sheet reduction. The hidden bullish case plays out without the worst of the bearish headwinds materializing at full force. Segment 8. What to actually watch. Here's your specific watch list for the Warsh transition and what it means for silver. All public, all free. Senate confirmation timeline. Warsh's confirmation hearing has not been scheduled yet. Watch for the Senate Banking Committee hearing date. If confirmation is smooth and fast, Warsh at the helm by May as planned. If contentious and delayed, policy uncertainty increases, silver volatility increases. June FOMC meeting, first under Warsh. If Warsh delivers the first rate cut as expected in June, short-term bullish signal for silver as dollar weakens. If Warsh surprises with a hold, short-term bearish as dollar strengthens. This is the first real test of whether the doctrine matches the implementation. MBS sales announcement. If Warsh announces actual MBS sales starting in mid-2026, watch long-term yields. If 10-year goes above 4.5%, real estate stress accelerates, private credit stress accelerates, capital preservation demand for silver increases. Comex registered silver through May. The vault drain at 785,000 ounces per day has nothing to do with Kevin Warsh. If registered silver continues falling towards 70 million ounces before Warsh even takes office, the structural story is accelerating independently of Fed policy. Watch CME Group daily vault reports. Shanghai Premium. If the $9 to $12 premium over Comex persists through Warsh's confirmation and into his first FOMC meeting, Eastern physical buyers do not care about the Warsh doctrine. They care about supply, and that signal is independent of Washington. Dollar index, the DXY dollar index. If it stays above 105 through the Warsh transition, silver faces currency headwinds. If dollar weakens after rate cuts begin, one of the primary bearish headwinds for silver disappears. Outro, the honest answer. So is the Warsh doctrine secretly bullish for silver? Here is the honest answer. It depends which Warsh you get. If you get the full Warsh doctrine as stated, aggressive balance sheet reduction, end of the Fed put, real price discovery in all markets, then yes, in the medium to long term, that is structurally bullish for physical silver. Because real price discovery means the 20.1 paper to physical leverage at Comex eventually cannot survive contact with reality. And sound money is a validation of why physical silver exists. If you get a modified Warsh, rate cuts as promised but balance sheet reduction slower than rhetoric, institutional inertia moderating the most aggressive policies, then the short-term headwinds from a strong dollar partially dissipate as cuts begin, and the structural physical silver story continues independently. The bearish case is real. Stronger dollar, higher long yields, reduced inflation fear premium, those headwinds are in the price right now. Silver at $92 after recovering from the 80.55 crash low has already partially digested the Warsh shock. What the market has not priced is the longer-term implication of a Fed chair who explicitly believes that markets should discover prices without central bank interference. Because the market where central bank interference has been most extreme, where paper claims on silver are 20 times the physical supply, is not gold. It is not oil. It is the Comex silver market. Sound money and real price discovery are the biggest long-term threats to the Comex paper pricing model. And the Comex paper pricing model is the only reason silver can be held at $92 while Shanghai pays $105 for the same ounce. Kevin Warsh may not have thought about silver when he wrote his sound money doctrine, but silver will feel the doctrine more than almost any other asset when it is implemented. Silver looks calm today, but the doctrine that just got nominated to run the world's most powerful central bank is quietly aimed at the very mechanism that keeps silver calm. This is financial warfare education, not advice. Do your own analysis. Pull the numbers yourself. Watch the Senate confirmation. Watch the June FOMC, and never confuse a paper price with a physical reality. If you watch this far with your brain turned on, drop OG John AG in the comments and tell me, do you think Warsh is the best thing or the worst thing that has happened for silver in 2026? OG out.